Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Penguin Solutions.
If you find our talks useful, please consider subscribe, like, and comment underneath. And, well, let's just jump right in because, what if the biggest bottleneck in this entire artificial intelligence revolution isn't actually the processing chips that everybody's obsessing over?
Right, the GPUs.
Yeah, exactly, the GPUs. What if it's actually the memory required to make those chips think? We just saw Penguin Solutions release their Q3 fiscal 2026 earnings on July 7, and the numbers they put up, they strongly suggest the market's been looking at the wrong piece of the hardware puzzle.
They really do.
I mean, we are talking about massive verified momentum in the AI memory space. They raised guidance across the board, and the stock has just been on an absolute tear this year.
It's been wild, honestly. And before we get into the mechanics of exactly why this stock is exploding right now, I just want to mention a useful chart tool for investors and traders listening. If you want help reading your trading charts more clearly, you can check out VIP Algos through the link below in the description.
Oh, yeah, for sure.
Yeah, so VIP Algos is a TradingView indicator suite. It shows visual buy and sell chart alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas. And you can use it across a bunch of markets like stocks, Forex, crypto, gold, indices, futures, and more.
It's nice.
Just remember, VIP Algos is strictly an educational chart analysis tool only. It is not financial advice, it does not place traits for you, and it absolutely does not guarantee profits. Trading always involves risk, so always manage your risk and do your own research. Also, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Awesome. So if you're listening to this and, you're looking at your own portfolio, you might be thinking, well, I already own the big chip makers. I'm exposed to the AI boom. Why do I need a company like Penguin Solutions?
It's a fair question.
Right. But looking at post-earnings momentum, that's one thing. Understanding the actual mechanism of what they are selling, that completely changes the entire wealth-building context.
It changes everything. Because Penguin Solutions, they aren't just another software company, and they're not some generic hardware vendor just, riding the coattails of the AI hype train.
Yeah, we've seen plenty of those.
Exactly. What they are is, well, I'd call it a backdoor play on the absolute next phase of AI infrastructure. Because right now, the whole industry is shifting from generative AI to agentic AI. And that shift, it creates this massive bottleneck that Penguin is just perfectly positioned to attack.
Let's actually slow down on that for a second, because that distinction between generative and agentic AI, that is really critical here.
Yeah.
Generative AI, it's basically like a really smart parrot, right? It predicts the next word in a sentence so it can write an email, or maybe it generates an image. But agentic AI,
that's a whole different ballgame.
Entirely different. Agentic AI takes autonomous actions. It reasons through complex multi-step problems. It might book a flight, cross-reference your personal calendar, check your bank balance, and negotiate with an airline's API all at the exact same time.
Precisely. And to actually do that, the AI has to constantly pull from massive, sprawling data sets in real time. It can't just rely on raw computing power. It completely relies on memory.
Right. Memory is the key.
If that data is just sitting on some slow storage drive somewhere, the whole system lags. The AI needs all of that context immediately available in active memory to make instantaneous decisions. So to solve this, you need unbelievable memory scalability across these massive server clusters.
I love this analogy of a master chef working in a high-end kitchen. Generative AI, that's like a chef who just needs a recipe book. That's your processing power. But agentic AI, that is a chef who needs 1,000 specific pre-chopped ingredients sitting at arm's reach on the counter just so they can grab them without taking a single step. I like that. That counter space is the memory. And Penguin Solutions, they're essentially building the biggest, most efficient kitchen counters in the world.
That is the perfect way to visualize it. And the thing is, they don't just sell the counter space. They provide an end-to-end AI factory platform. They integrate the advanced memory technologies, the infrastructure software, the physical compute systems, and the services to keep it all running together seamlessly.
All under one roof.
Exactly. When you're the one building the entire factory floor, rather than just selling one isolated component, your growth becomes incredibly sticky. It's much more durable.
Okay, so they're building these massive end-to-end factory platforms. But building physical infrastructure at that scale, that requires an astronomical amount of cash up front. It's incredibly capital intensive.
It is.
Does their balance sheet actually support that kind of ambition? Or are they drowning in the cost of all those parts. Because when we look at the fundamental numbers from this Q3 fiscal 2026 blowout, what stood out to you?
The numbers are staggering, honestly. So for the quarter ending May 29, 2026, their net sales hit a record $478.7 million. That is a 48% increase year over year.
Wait, a 48% jump?
Yeah.
For a company that is moving physical infrastructure?
Yep.
I mean, software companies can scale revenue that fast because code is practically free to reproduce. But achieving 48% growth when you are physically shipping heavy server racks and memory clusters, that's massive.
It really is. And the key is looking at exactly where that growth came from. It was largely driven by their integrated memory segment. That segment actually doubled year over year.
Wow, doubled.
Yeah, which proves that the market is rapidly waking up to that memory bottleneck we just talked about. And this isn't just top-line vanity metrics either, where they're selling at a loss just to gain market share. Their GAAP operating income rose 417% to $51 million.
417%. That is the power of operating leverage right there.
Exactly.
When revenue grows by 48%, but operating income explodes by over 400%, it means their fixed costs are already covered. Every new dollar coming in the door is flowing almost directly to the bottom line. So their non-GAAP EPS jumped 79% to $0.84 as a result.
Spot on. And management clearly knows this momentum is sustainable because they actually raised their forward guidance. They're now targeting 22% net sales growth for the fiscal year, and they're doing this protected by a serious competitive moat.
Right, the partnerships.
Exactly. Penguin is an NVIDIA AI Factory specialized partner, and they were just named Dell Technologies Global Alliance's America's AI Partner of the Year.
And see, those aren't just, empty corporate awards or little plaques on a lobby wall. Being the specialized partner for NVIDIA and Dell, that means you are the golden ticket inside the supply chains of the biggest enterprise and sovereign AI projects on the planet.
Oh, absolutely.
It embeds Penguin so deeply into these projects that the switching costs for a client if they wanted to rip them out and go with a competitor, it would just be astronomical.
It creates a massive barrier to entry.
Yeah, here is the but, and I've got a big one here.
Let's hear it.
You're painting this incredibly bullish picture of their partnerships and their operating leverage.
Yeah.
But I was looking at the internal data, and I'm seeing some glaring red flags that make me question this whole narrative.
Okay, regarding the cash flow.
Yes. Growth is stellar, yes, but the working capital drain is severe. Their Q3 operating cash flow was actually negative $74.8 million.
Yeah.
And if you look at their accounts receivable, which, for everyone listening, that's money they are owed by customers but haven't actually collected yet, that ballooned to $703 million.
It's a big number.
It's huge. And worse, their inventory is sitting at nearly $500 million. Specifically, $498.3 million.
So I have to ask, are they just bleeding cash to chase this growth? It looks alarming, I admit. But context is everything when you analyze a hardware balance sheet. When an infrastructure company is scaling at a 48% year-over-year revenue clip, heavy working capital usage is almost a mathematical certainty.
Sure, you have to buy the parts.
Right. You have to buy the components, build the servers, and assemble the memory clusters way before you can deliver them and actually bill the client. Given their raised forward guidance and the strength of those Dell and NVIDIA partnerships, this really reads as a highly strategic inventory buildup to meet confirmed, locked-in AI demand, not a structural failure.
So they're front-loading the cost because they already have the purchase orders sitting on the CEO's desk.
Exactly.
It's like that highly rated restaurant again. They're ordering months' worth of incredibly expensive, perishable ingredients,
Right.
but they're only doing it because their reservation book is completely full for the next 2 years.
That's it. They are buying the parts to build the factories they already know they have to deliver.
I like the analogy, but it also highlights the exact danger here. If you have $500 million in perishable tech inventory sitting on the shelves, you desperately need a catalyst to validate that aggressive buildup. You need to clear that inventory before it becomes obsolete.
Oh, for sure. The tech moves fast.
So what is the trigger event that actually proves this strategy is working?
Well, the most immediate catalyst will be their Q4 fiscal 2026 earnings, which are expected around October 2026. Given the momentum and the raised guidance we just saw, consensus expectations are likely going to be revised aggressively upward.
Right.
But beyond just the raw earnings numbers, the real catalyst is product adoption. Specifically, the market adoption of their newly expanded Clusterware AI operating system.
Clusterware AI. Let's explain the mechanics of this, because why does an infrastructure hardware company care so much about an operating system?
Because software is where the margins are. And it's what makes the hardware sticky. They are rolling out an AI factory operations agent within this system. It essentially allows operators to use natural language queries to automate incredibly complex server cluster operations.
Natural language.
Yeah. Instead of a data scientist writing complex code to reroute server loads, an operator literally types into a prompt, hey, optimize cluster B for heavy memory retrieval, and the software just does the rest.
That's wild.
Yeah.
It's essentially using AI to manage the physical infrastructure that powers the AI.
Exactly. It completely democratizes the management of these massive AI data centers. If Penguin can showcase strong adoption of this software at upcoming industry conferences and in their Q4 earnings, it radically changes their valuation model.
Because it changes the narrative.
Right. It proves they aren't just a low-margin hardware middleman passing Dell and NVIDIA parts along. It shows they have high-margin, sticky software revenue, too.
So we have this massive upcoming earnings catalyst in October and the rollout of their new software. But how is the market actually pricing in that anticipation right now? Because if we pull back and look at the price action.
The price action has been violent. Wild is honestly an understatement here. If you pull up the daily chart for this year, it looks like a heart monitor of someone skydiving.
It's a great image.
The stock is up a staggering 246% year to date. It's currently trading right around $62.71. And the momentum post-earnings was explosive. After they released those record results on July 7, the stock gapped up over 11% in extended trading. And the volume, it was running at 1.5 times its 3-month average.
That kind of volume, that means serious institutional conviction stepped in right after the print. That isn't just retail traders buying the news on Robinhood. That's big funds accumulating shares.
It is. But here's the technical nuance that you really have to pay attention to. Despite that massive year-to-date run, the stock's currently about 19% off its 52-week high of $77.40, which it hit back in late June.
So a bit of a cool down.
Yeah, we are seeing a significant pullback and consolidation. It's digesting that 246% run and navigating a chart that has a multi-100% run-up followed by a sudden 19% drawdown. That is exactly why traders rely on clear levels.
Oh, absolutely.
Finding reliable support and resistance zones when volatility spikes like that is crucial, which naturally highlights the utility of a tool like VIP Algos to keep your chart workflow clean.
And that volatility is no joke. I mean, despite that huge 11% pop on the earnings release, we've still seen the stock experience intraday drops of over 7% recently. That high momentum cuts both ways.
It really does.
A stock that can gap up 11% overnight can just as easily gap down 10% if a single macro headline spooks the AI sector or, bond yield spike. It is a highly, highly sensitive asset.
Absolutely. The chart structure is long-term bullish. It's making higher highs and higher lows.
Yep.
But the short-term swings are violent. It is not for the faint of heart.
Wait, before we talk about retail traders navigating this volatility, we really need to talk about what the people inside the house are doing.
The insider flow.
Yeah, because on the surface, the market sentiment narrative is decisively bullish. The headlines are screaming about how Penguin Solutions smashed estimates and raised guidance. The analyst community is scrambling to update their models. But there is a major conflicting data point here, and I just cannot ignore it.
Let's lay it out.
Over the past 90 days, insider flow has been heavily, heavily negative. The company's own insiders have sold a net 92,122 shares. We are talking about 29 individual sell transactions compared to exactly one buy. The quantitative insider score is literally at negative 100 out of 100.
Yeah, it's stark.
Why on earth should you be buying the hype when the company's own executives are aggressively sprinting for the exits?
It looks terrible. I completely agree. And it's a completely valid red flag on the surface. But you have to contextualize this executive behavior within the timeline of a hypergrowth tech company.
Yeah, how so?
When a stock runs 246% in a single year, insider profit-taking is incredibly common. And honestly, it's expected. Executives have personal financial lives. They diversify when their net worth suddenly triples on paper. A VP taking profits after a multi-100% valuation expansion. That doesn't inherently invalidate the fundamental AI demand that the company is servicing.
I'm sorry, but I have to push back on that. I get taking some chips off the table to buy a boat or pay a tax bill, but 29 sells to one buy.
I know, the ratio is tough.
If we're truly in the early innings of a multi-year supercycle like management claims, and if this new clusterware AI software is really going to revolutionize their margins, why aren't the architects of the product holding on for the real payout? If my net worth is tied to a company that's allegedly solving the biggest bottleneck in artificial intelligence,
Yeah.
I'm holding.
That is a totally fair challenge. The counter-argument is that many of these sales are pre-scheduled 10b5-1 trading plans.
Right, the automatic sales.
Yeah, executives set these up months or even years in advance to automatically sell portions of their stock at specific price targets. It avoids insider trading accusations. When a stock jumps 246%, it just triggers all of those automatic sell orders at once. But I concede your point. Even if it's programmatic, the optics of heavy insider selling while pumping up future guidance requires investors to proceed with caution.
Definitely.
The external demand from Dell and NVIDIA is real, but management is clearly taking their winnings right now.
Which perfectly bridges us into the actual risks. Because there's always a downside, especially when executives are cashing out at these altitudes.
Right. The most obvious threat is valuation risk. The stock is currently trading at a trailing 12-month PE ratio of nearly 60.
Wow, 60.
Yeah, to put that in perspective for you, the broader market typically trades around a 20 PE. When you are trading at a multiple of 60, absolute perfection is priced in. The market expects flawless execution.
Any misstep is going to hurt.
Exactly. Any slight miss in upcoming quarters, any hint that guidance might be softening, or any delay in their software rollout, and that valuation multiple will contract violently. The stock will get punished even if the underlying business is still growing just because it didn't grow fast enough.
And that ties right back to execution risk, which I think is the real elephant in the room here.
Yeah.
Let's bring back our restaurant analogy.
The perishable ingredients.
Exactly. They have a $500 million inventory buildup of expensive, perishable tech ingredients. The whole bull thesis relies on their reservation book staying full.
Yeah.
But what happens if the macro environment shifts? We know entire countries are spending billions on sovereign AI projects right now.
Massive budgets.
But if sovereign AI demand suddenly cools down, or if a major government just decides to delay their payments for a few quarters due to budget constraints, that's $703 million in accounts receivable. That turns into bad debt.
That is the exact structural risk. That strategic inventory instantly transforms into a massive liquidity crisis.
Right.
We already know their 9-month operating cash flow was only $11.2 million. They don't have an infinite cushion of cash lying around.
Right.
If those parts just sit on the shelf, or if customers demand renegotiations on pricing, Penguin Solutions is caught holding a very heavy, very expensive bag.
So with everything on the table, the explosive 48% growth, the Dell and NVIDIA partnerships, the massive memory bottleneck they are solving, but also the glaring insider selling, the negative cash flow, and the massive inventory build. What is the final verdict?
Based on all the underlying research and financial data, the final stance is a bullish score of 8 out of 10.
8 out of 10, okay.
Yeah, the core thesis here is undeniable. Penguin Solutions is a premier AI infrastructure player experiencing legitimate, verifiable hypergrowth. Their elite partnerships and that staggering 417% jump in operating income. It shows they are successfully capturing market share right at the heart of the AI memory bottleneck.
But the risks remain.
Yes, there are very real risks with the premium valuation and the short-term cash flow pressures from their massive inventory build. And the insider selling is definitely a caution flag. But the momentum signals and the broader shift toward memory-intensive agentic AI suggest that this growth phase is likely just beginning.
And what is the target horizon for an investor looking at a play like this?
The target horizon here is a multi-year hold, specifically 12 to 24 months. This isn't a quick flip for a day trader. You are looking to hold to capture the full deployment cycle of this next-generation agentic AI infrastructure. And you are waiting for the potential margin expansion as their high-margin software offerings, like Clusterware AI, begin to scale up and get adopted across the industry.
Just a clear reminder for everyone listening, this is our analysis of the data, not financial advice. We are absolutely not telling you to buy, sell, or hold this stock. And if you want a cleaner way to read your trading charts and manage the kind of violent volatility we talked about today, check out VIP Algos through the link below in the description.
Highly recommend checking it out.
VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can definitely help make charts easier to scan, but remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. Again, this is an affiliate link, and we may earn a commission at no extra cost to you.
And if this analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next show.
You know, we talked a lot today about the memory bottleneck and how their new software manages these massive server clusters using natural language. But it leaves you with a really fascinating thought. As agentic AI gets smarter and begins to reason through more complex problems, it will eventually learn to optimize its own architecture. If AI eventually learns to write its own code to manage and optimize its own memory clusters, does a company selling human-operated software to manage that memory eventually code itself out of a job? Something to think about.